guys, that is the 15-minute break conclusion. We will now be getting back to page 443. 443 in the workbooks is progressive exposure. After this, we will take a 5-minute break. This section should last just about an hour and 15 minutes. So let's get back to Mark and Mark for progressive exposure, page 443.
Okay, welcome back. We're going to move to page 443. We're in the risk management section in the second workbook. I know there's been a lot and it may be overwhelming, but bear with us here. There's still a lot more as well. But again, these are things that you really not only you need to know, but you need to study and you need to work on. And this is really what it's all about. This section really brings it down, and we're using a lot of examples to illuminate points in many different ways to hit you from every angle. So we really make sure that you're getting this. And because sometimes one way we say it, one person understands it, but then you got to say it a little bit differently or show a different example, different metaphors, and so forth. What we're going to get into now is what we call progressive exposure, and also having you understand that trading is not an on or off business. It's not just a green light on, red light off, where the market's, it's a buy signal. I know we get into these buy and sell signals that, we've got these services and these indicators and so forth, buy, sell, but there's a lot of there's a lot of gray area in between, and what we found is the best way to trade is to trade incrementally, and we're going to show you what that means. And also, this is a big part of managing risk. So the first thing you want to always realize is that you should always think in a small success leading to big success, meaning that let your smaller trades give you the direction as to where you should go with your larger trades. So whenever I get back into the market, and again, this is a perfect example, you're in a tough market, you're in a bear market, and I'll just ask you, Mark, if you're in 100% cash and you're in a real difficult market and maybe you haven't been doing that well or you've been out for a while, all of a sudden you start seeing some VCP setups. Are you coming in and just going hog wild and putting your whole account in a couple stocks and taking big exposure right off the hop?
Absolutely not. The idea obviously being, which we're going to get into in this section, but, you have to jockey for position and gauge the health of the market and by sticking a toe in first. It's the same old analogy of, do you want to just jump in the deep end of the pool without checking the temperature of the water first? That's a recipe for volatility in your returns that you don't want if you do that. That's sort of the cowboy mentality, where the real professional mentality is to start at the other end and test the waters first, and only really get aggressive when you feel like the timing, and everything is correct, which we'll get more into.
Yeah, and taking the temperature is a great a great metaphor or analogy of taking the temperature of the market, taking the temperature of your strategy, of whether things are working or not, the stocks are breaking out. And remember, we want to look for those confirmations, violations. So when Mark or I go back into the market, even David Ryan would tell you the same exact thing. Bill O'Neill would tell you the same thing, that we're gonna take a few small trades and start off with some smaller exposure. Usually I'll go in with about 25% exposure, will be sort of my first toe in the water. It may be 25% position, and maybe 5% positions, depending on what I'm seeing in the market, if there's a lot of stock setting up or not. But I'll put that proverbial toe in the water and take the market's temperature. And this also works mathematically. I'm going to show you how the math works. And this is what we call financing risk. We're always looking to finance risk, improve our worst case scenario, and always maintain mitigating that downside. So again, when you first go into market, it's all risk. You have no profits to work with. You don't have any cushion. It's all risk. So you incrementally want to move yourself into the market. And So let me show how this, let me give you a few hypothetical examples of how this would work. So say your first trade, you've got a 4% stop, okay? And it represents $1,000, right? And so you're a 2-to-1 trader. We're just going to use 2-to-1 and say on average, you're 2-to-1. So if you had a winning trade, it would average 2,000. So we'll say that you made $2,000 on this trade. It was a winning trade, right? So now you've got $2,000 that you've banked, and you've now financed 2 more trades. If you went and used that same risk and you backed into another trade, and say another trade comes out of a VCP and you use a 4% stop, well, now if you lost in that trade, you would lose $1,000, and you still have $1,000 for another trade. So you're financing your larger size, or you can double your size. If you doubled your size, now you would, if you lost on that double size, you're going to be right back to where you were, no loss in your account as far as from your starting capital, your principal, and you've financed a larger amount of risk. Like I said, this is what we call progressive exposure. And this is something that Mark and we do just axiomatically. Now, automatically, we'll constantly gauge by using test positions. Now, once we get some feedback and trades are working, then you can jump to larger positions and you can start trading at a larger exposure. But here's the thing that you have to remember, and again, this works in the opposite too. Okay, Mark, if trades start going against you, let's just say you came in with, I don't know, 10% position sizes, you took a couple of them, and you get a bunch of losers in a row. Now what are you doing? What are your next trades going to be?
Smaller.
Yeah,
absolutely. I think of it, in terms of, just like we talked about those sliders before. It's a sliding scale in terms of that feedback in the market telling me, either more aggressive, more conservative. So if I come into the market and get whacked, I'm not coming back in with the same size. Because again, even on a portfolio basis, I want to wall off that left side in terms of the drawdown. So if the market is, I know the criteria is good, but I'm losing, I know the market is bad. The only thing I can control, is my sizing at that point.
Right. So let me give you another example here of how progressive exposure works and how you would scale yourself up, and then you would even scale yourself back down. So now let's just say your position size, your maximum position size that you're willing to risk would be 25%. 2-to-1 trader, that actually is your mathematical optimal position size, would be 25%. So that would be where you're trying to get to. You're trying to get to your bigger positions being 25%, but you're just getting into the market. So you take a quarter position, right? Which would be 6.25%. You risk $500. Okay, but that you win. You win 2-to-1. You make $1,000 on that trade. All right. Now you can bump your size up. Right, you double your size to 12.5%, and you're risking now $1,000 because you've doubled your size. Well, let's say you get 2 trades in a row that are winners, and that's now a $2,000 because you risked 1,000, 2-to-1, $2,000. Right now you've got $3,000 profit. You can now move up to that full position, and even if you lose, you would still have $1,000 left over and be able to move to a half position, which you could scale back down. Now that things aren't working, you lose on your big trade, you can scale back down if you'd like. Even if you kept it the same size, you're going to lose less than you originally risked, because now you've got $1,000 more to work with. So this is how you would expose yourself. Now, the reason why you do this is because you want to pyramid yourself into trading your largest when you're trading your best, and always be guaranteeing yourself to be trading your smallest when you're trading your worst. And the only way to do that is to bend with the market, is to bend with the results. So when things are going well, you step it up. When they're not, you bring it back. What happens is, yes, sometimes you bring it up and then things go bad, and you bring it down, and then it starts going well, and you wish that you did the opposite, and you got really aggressive when things are bad. You can go back in hindsight and Monday morning quarterback. But the bottom line is that outside of that noise and those short-term back and forths that you're going to, as Mark said earlier, jockey for position, you are going to guarantee yourself that when things are going really well, you're going to be having big size on, and you're going to be making big money in the bull market. And when you go into the bear market, you're going to guarantee yourself that you take your size down until it's negligible, and you are going to be in cash or near cash, and you're never going to get yourself in trouble. And this is the reason why I've participated in every bull market in the last 9 bull markets in 30 some odd years. And I've never been caught in a single bear market, not one single time, having heavy exposure, because I bend. I progressively expose up and I progressively expose down. Mark, in the years, the 13 years that you laid down these great returns, have you ever been caught in a big downdraft, even one single time?
No, for this reason, and I think this is really, just go back to that last slide real quick, just to make it really simple, because one question we get is, well, why not just go in big right away? You're going to be there, you'll eventually be there when things work, and well, that's true, but the reality again is these periods are not evenly distributed. And so if you think of it in terms of, if you're a 50-50 trader, it's not always win-loss, win-loss. You have these runs of wins and losses, and you want to use that to your advantage. So if you look at it, in this case, if you use progressive exposure properly, and one trader does exactly like the slides here say, trade 1, 2, 3, versus just starting at trade 3, risking $2,000, who's going to wind up? They're both going to be trading big. It's going to take the one who does it in order a little bit longer, but they're going to be risking a quarter in order to finance the ability to get there, versus the other one who just goes in big every single time. And the volatility in their trading is going, again, to the point we were saying before. You would think there's this massive difference. It's often smaller than folks think, and learning how to do this properly. And I've heard many of Mark's students over the years say that this lesson has made the biggest difference in the long run in their trading, understanding and learning how to do progressive exposure properly.
Yeah, in almost all the cases of all the really successful traders that we've trained, progressive exposure is always mentioned as one of the main things that changed their that made them successful and changed their trading from being mediocre to being outstanding, is understanding this and applying it. Now, a couple things I want to say. Again, starting, as Mark said, starting right out and coming out with big positions. Well, you can, in hindsight, in this example, yeah, that would work. But what if those first couple trades, or all 4 of those trades, were losers? Now you're in the hole. And this goes right back to the previous example of losses work geometrically against you. So what happens when you get into the hole and you're down 20%? It takes a 25% gain to break even. If you're down 50%, it takes 100% gain to get even. So now you're allowing the losses to get you in a hole, and now it's going to take you more work to get out of that hole. That's why you have to protect the downside. You can't go into the hole too deep, or it's going to take much more work, because losses have a bigger impact on you. So that's the real reason, is because losses work geometrically against you, and that's why you have to mitigate the risk up front. Yes.
And you brushed over this briefly, I think, in one of the previous slides, the idea of always trying to improve your worst case scenario. I think people have to really think through, what does that actually look like in practice? Well, this is what it looks like right here, because the worst case scenario is you just get clobbered on trade 1. Or maybe you go into 4 trades and then wind up losing. Well, who's improved their worst case scenario? If you use this progressive exposure and you get hit on the first trade versus coming in with big size, you lose a quarter the amount. And if you scale up properly and then everything gets hit, your P&L is at 0, where somebody else is now negative. That's improving the worst case.
Another great point, Mark, and that leads to something that is really important to point out, is that what we're doing, not only do we always want to improve our worst case scenario, but we want to improve our potential. We want to increase the potential for reward. So as Mark, what he's saying here is that we're increasing our exposure, but while at the same time reducing our risk. So we're creating asymmetric leverage. and moving ourselves into a situation that is low risk to maintaining a low risk downside, but increasing the upside. And
That's
then
that's a gold mine, not just a gold nugget right there.
it is. It's everything. It's the whole ball of wax. It's what it's all about. Let me show you another example here. And this is where financing, where as you use progressive exposure, you're financing your future trades. As I said, small success leads to big success. And what you're trying to do is create profits, so then you can increase. You want to increase your size. That you want to get to when the market's good. You want to increase your size. That's what differentiates the great traders from everyone else. Is that someone like Mark, myself, when we see the whites of the eyes, we're unloading the mag. We're putting the pedal to the floor, and we're making lots of money when times are good. And that's, we don't have to have very long good times because we're getting so aggressive at that time, but we're never doing it just haphazardly or taking a lot of risk. We're always doing it on the backs of prior success and financing that risk, those bigger positions. So here's again how it would work in real life, where let's say you do have a market that's improving and you start off with a small position, you make a profit, you make $1,000, you bump it up, you bump your position size, your next size to 12.5%, you double it, you get another profit, you double it again. Now you get a little win streak, you got 3 in a row. Well, what you just did is you just financed by going from 6.25 to 12.5 to 25%, and very incrementally and slowly taking small risk to larger risk and financing it the whole time. You're only at real risk of principal on the very first trade. You've now financed